this video, we want to conclude our lesson on earnings per share. So today we want to look at diluted earnings per share. We've already looked at basic earnings per share under several circumstances. We've looked at basic earnings per share when there is a market issue, basic earnings per share when there is a bonus issue. We look at basic earnings per share when there is a market issue and bonus issue in the same question. And we also look at when there is a right issue, how do we determine our basic earnings per share. So in this lesson, we are going to focus on diluted earnings per share. In fact, so if you've not watched the previous lessons, you can go to the channel where we have earnings per share 1, earnings per share 2, earnings per share 3. That covers all that I've mentioned earlier. Once again, do not forget to share this content with others. Help us to grow and to reach out the wider students so that they can also come and form part of the learning community. So help us by supporting this agenda. Help us by subscribing. If you want to support us, help us by subscribing, share with others, and recommending us to other students so that we can reach out to a large number of students so that they can also become part of the learning family. Thank you for supporting us. Thank you for subscribing. Thank you for being with us all this while. We appreciate you. Okay, so we want to look at diluted earnings per share. Do not forget that still the treatment, how to determine, how to compute diluted earnings per share is still accounted for under IAS 33. So we are still on IAS 33. Okay. Okay, so we want to look at diluted earnings per share. So diluted earnings per share. Now, what is diluted earnings per share? Because we already looked at basic earnings per share to be the general earnings per share. I've explained what is earnings per share already. Now, when you talk about diluted, it's like you are having a thick water, like a muddy water, or in fact, you've even prepared some stew or you prepared some soup and it's very thick and you want to make it light. You add more water to it to make it light. Most of the times when you prepare food and maybe the pepper or the salt is overdosed or is more than what is required, is more tasty and you want to reduce it, you add more water. The process of adding more water, making it a bit light, is what we call diluted or dilution. When you come to accounting, when we talk about diluted earnings per share, there are some times that certain things or certain circumstances occur in the business that warrant or that propel, that account for the earnings per share to be diluted, to be lighter than what it was before. What I mean to say is that we may have a basic earnings per share to be $5 per share, but because of that circumstances, that situation in the business, we may end up having the earnings per share at the same date being 4.5 per share. So this means this has been diluted. It has reduced. That is what we call dilution or diluted earnings per share. Now I'll explain. I'll go into details what accounts for diluted earnings per share, the circumstances or situations that account for diluted earnings per share. But with this, I'm saying that anytime the basic earnings per share has been reduced to a certain number of earnings per share as a result of some happenings in the business, some circumstances in the business, then we are looking at diluted earnings per share. Now, the standard requires that entity account for what is diluted earnings per share. The standard requires that entities must provide information on their diluted earnings per share and account for the current one and the comparative diluted earnings per share. So it's also very, very important that we understand and how to compute diluted earnings per share. Now, what accounts for diluted earnings per share? What accounts for diluted earnings per share? There are sometimes entities take decisions or take contracts, they undertake or enter into contracts today, but this is going to affect our capital structure in the future. What I mean to say is that an entity can enter into a contract today. You will look at those contracts very soon, where those contracts will warrant that the share capital of the entity will be increased in the future. The share capital of the entity will be increased in the future. Remember that when we were looking at basic earnings per share, we said that it's our profit after tax, which is also known as our earnings, divided by our weighted average number of shares. Weighted average number of shares. Now remember that if the denominator, the weighted average number of shares increases and there is no proportionate increase in the earnings, then we are going to have something lesser than what we have previously. Assuming we have 10 here and here we have 5, this is going to give us 2. Assuming these remain the same and we are having 7 here, this is going to give us 1 point something. So you see it has reduced as a result of increasing the denominator and there is no proportionate increase in the numerator. So these circumstances is what is accounting for what we call diluted earnings per share. So there is some circumstances today. There are some instruments in the business today that will warrant that the share capital of the entity, the ordinary share capital of the entity will be increased in the future, which accounts for what we call diluted earnings per share. Now, what are some of these circumstances that account for diluted earnings per share? The basic one is what we call the convertible instrument. Convertible instrument. If you want to know more about compound instrument, which a typical example is convertible instruments like convertible bond and convertible preference shares, convertible loan notes. If you want to have more understanding on that, you can watch IAS 9, IFRS 9, IAS 32, and IFRS 7. They are those standards that account for financial instruments. But here we want to basically concentrate on the aspects that account for diluted earnings per share. Okay, so like I mentioned, convertible instrument. A typical example is a convertible bond, a convertible preference shares, or a convertible loan notes. We can also look at share options, or we call it options or warrants. So options or warrants also give rise to what we call diluted earnings per share. When we talk about options or warrants, it is a contract that gives the holder a particular right to be exercised in the future. So it's a contract between an entity and another party. That party is given some form of right, and that's right to be performed in the future at a predetermined price. So when we talk about options or warrants, we can say that, in 3 years to come, we will sell a number of shares to you at a price that have been determined today. So you see, the contract is today, the circumstances is today, but it's going to take effect in the future. When that happens, there might be an issue of diluted earnings per share. When we talk about the issue of convertible loan or convertible preference shares, it is giving the right to the holder that it can convert those loans into shares in the future. So once those loans are converted to shares in the future, we are going to increase our capital structure. The value, or in fact, the number of our shares that were capitalized by the entity from the beginning will be increased, and this is going to have effect on the numerator, which is our earnings, and therefore is going to dilute our earnings per share. Now, with the other complications and other exceptions, I will mention them as we moved along in the lesson. But for now, let's look at how to determine or how to compute diluted earnings per share. All right. So I'm just changing this one. So for you to compute your diluted earnings per share, first you must compute your basic earnings per share, which we have looked at in the previous lessons. You must first compute your basic earnings per share. After you have computed your basic earnings per share, you can now compute your diluted earnings per share. And diluted earnings per share is our profit after tax. By now you would have adjusted it before you use it, because you will use it for the computation of your basic earnings per share, plus notional interest. Notional interest. Notional interest. I'll show you what is notional interest very soon. Then this is also there, weighted average number of shares outstanding during the period, plus notional shares. Notional shares. So once you've gotten these two figures, you can compute for your diluted earnings per share. Now, what is this notional interest? Let me quickly talk about notional interest, and we talk about the notional shares. Then we can take some example and see how we can compute for our diluted earnings per share. With the diluted earnings per share, we will look at it differently under the two circumstances. We will look at when it is a preference, convertible preference shares or convertible bond. They are the same. Then we will look at when it is options and warrant. The treatment or the computations differ. So we will look at them separately. All right. Now, when we talk about notional interest, when we come to options and warrant, we don't have anything like notional interest. This is only when we are looking at convertible preference shares, convertible bond, convertible loan notes. Okay. The word is convertible preference shares, convertible loan notes. That means it's a liability. And anything that is a liability to the entity, that means entity pays some form of interest on it. Once you convert those loans into ordinary shares, you cease to pay interest on them. You cease to pay interest on that particular loan or that particular liability. Therefore, that interest that you are supposed to pay as interest, which now you are converting those instruments into ordinary shares, those instruments, those interests will now be capitalized or will now be considered as a profit. So here we can look at notional profit or notional interest as a profit. But don't forget, we have to take into consideration tax. So we may be having 4 million 5% convertible loan, 4 million 5%, 5% 4 million convertible loan. Okay, so this means that 5% of this value is going to be our interest. But since we are going to convert this loan into shares, we will cease to pay the interest. So 5% of the 4 million becomes a notional interest after we have taken tax into consideration. That's what we are looking at as a notional interest. Now, the question is, how much will this 4 million be converted? How many shares can this 4 million loan be converted into? How many shares? So the question will give you scenarios. It will give you series of options under which we can convert this 4 million convertible loan or convertible preference shares or convertible bond into. And that amount or that number of shares we can convert this loan into is what we call the notional shares, the notional shares. So in this case, we can say that, every $100 should be equivalent to 100 shares. To be equivalent to 100 shares. So what it means is that we would take the 4 million divided by 100 times the shares. So this will give us the notional shares. This will give us the notional shares. Now, please take note. Anytime we want to look at the conversion of potential ordinary shares. Okay, we want to look at these they contain potential ordinary shares because it's going to be in the future. They contain potential ordinary shares. Now, anytime we want to convert those shares into ordinary shares, so we are looking at two things here: potential ordinary shares into ordinary shares. Once they are in the form of convertible loan, convertible preference shares, they are potential ordinary shares. We've not yet converted them into our ordinary shares, but they are potential. That means we can convert them. So take note, it is deemed that every potential ordinary shares is converted into ordinary shares at the earlier parts of the accounting period, at the earlier part, not at the end, at the earlier part of the accounting period. Or if later, the date on which the potential ordinary shares, or in fact the normal ordinary shares is what is issued. So two things. We assume it is deemed that potential ordinary shares is converted into the ordinary shares at the beginning of the accounting period. Or if later, we are saying that it is issued at, we assume that it is issued on the date that we convert the potential ordinary shares into the ordinary shares. Please take note. Anytime you have several options for which you can convert your shares into, because you may have option 1, which is year 1, option 2, which is year 3, option 4, which is year 4. You always go for the options that gives you the highest shares. You always go for the options that gives you the highest shares. All right. So based on what we have established this one, let's now take some practical example which will help us to implement our understanding on diluted earnings per share and how to compute for our diluted earnings per share. So as I always do, I'm putting my question here. So assuming that we are having our earnings of 4 million at the end of year 2. So we are looking at the end of year 2. Okay, and as at this date, we are capitalized with this is rather, let's make the earnings 12. Okay, 12 million. Then we are capitalized with 12 million, with 4 million shares. 4 million shares. Now the entity is having 5% 4 million convertible preference shares. Now this convertible 5% 4 million preference shares can be converted into several options. So it can be converted at the end of year 2, at the end of year 2, at the end of year 3, for every $100 to be into 120 shares. 120 shares. So we can let's make it small, so into 30 shares. Then at the end of year 3, every $100 into 25 shares. 25 shares. Okay. This convertible loan is assumed to be at the beginning of the period. I will explain when it is not at the beginning of the period. I will explain. Okay. So let's assume that our tax rate is 30%. 30%. What is your diluted earnings per share? So after using this particular example, I will give you another scenario that contains other exceptions. Okay. Now, I said earlier on that for you to compute your diluted earnings per share, you always have to compute your basic earnings per share. Don't forget. Before you can compute your diluted earnings per share, you first have to compute your basic earnings per share. So let's look at our basic earnings per share here. So our basic earnings per share in this particular question, basic earnings per share, we don't need any table to compute our weighted average number of shares because we are just looking at the entity is capitalized with just 4 million shares at the beginning of the period. So we don't need any table. Assuming that we are having multiples issued during the period, then you will need a table to determine our weighted average number of shares. Please, those lessons are under the previous ones. Lesson 1, lesson 2, lesson 3 all contain the table how to determine our weighted average number of shares. So you can chance on them and then appreciate what we are doing here. Now, the basic earnings per share here is going to be our earnings, which we don't have any adjustment. Remember that if there were to be any non-cumulative preference share dividends, we would have eliminated it. So here is going to be $12 million. $12 million, all divided by our weighted average number of shares, which is 4 million shares. In this question, there is we are not adjusting the 4 million because we are just capitalizing 4 million shares, like I indicated earlier on. So this is going to give us $3 per share. $3 per share. Now, with our diluted earnings per share, we are saying that it's going to be the earnings, so profit after tax, plus our notional interest, all divided by our weighted average number of shares, plus our notional shares. All right, so we already know our profit after tax to be 12 million, plus we don't know our notional profit. We only know that we are capitalized with 4 million shares, but we don't know our notional shares. So let's determine that. How do we determine our notional interest? I said that the notional interest is, the concept is that since we are going to convert this preference share, which we are paying interest on into, you will no longer be required to pay the interest. So that amount becomes a profit to you, like an interest to you. That's what we call notional interest or notional profit. Okay. So here, the notional interest is going to be the 4 million times 5%. Now, don't forget that anything you get here, we will take away our tax. So let's see what we get. So 4 million times 5% is giving us $200,000. Then we will take our tax away. So tax of 200,000 times 0.3, because they say our tax rate was 30%. So we multiply this by 0.3. That's giving us 60,000. So we take this from this to get our notional interest of $140,000. So we will add, since this is in this one, this will be 0.14. Since I'm leaving this one is 12 million, this will be 0.14 million. You can also bring the zeros. Okay, 0.14 million, because it's $140,000. So this is our notional interest. This is how to determine our notional interest. Now please pay attention here. This convertible instrument was deemed to be issued at the beginning of the period. Assuming that it was issued maybe during the period, then please, this profit here, we must take the date into consideration. So assuming that it was issued on the 1st of March during that year, then we issued it as the assumption that we issued it on 1st of April. So this particular profit here would have taken 9/4, because from April to December is 9 months, assuming the accounting period end of the entity is December. So please take note. Take note on the date on which the convertible instrument is issued. This one was deemed to be issued at the beginning of the period. That's why we are taking the full 12 months. All right. Now let's look at how to determine the notional shares. Now we have our notional interest or notional profit. Now, they said that we are having two options here. Now the first option is every $100 of the convertible instrument to be 30 shares, and every $100 to be 25 shares. Like I stated earlier on, we always go in for the options that will give us the maximum number of shares. That will give the holder the maximum number of shares. So in this case, we are going for the option one. So it means that our notional shares is going to be the 4 million, all divided by, let me bring all the zeros, 4 million, all divided by 100 multiplied by 30. So let's look at that. So again, if this were to be issued during the year, then we'll take whatever we will get, we'll take the month into consideration. We'll take the month into consideration. So 4 million divided by 100 times 30 is giving us 1,200,000 shares. 1,200,000 shares. So that's our notional shares. That's our notional shares. Now we can even check for dilution before we continue. Okay, we can check and see if the this additional convertible instrument is giving us dilutive, or it is dilutive in nature. I'll come there. That's the next I want to look at. There are some times where so take note, let me just talk about it at once. There are some times where the convertible instrument, the warrant or the options will not be dilutive in nature. They will not be dilutive in nature. What I mean to say is that they will not dilute, their additions will not dilute the basic earnings per share. If that happens, there's no need for diluted earnings per share. So always you have to check and see if the potential ordinary shares is dilutive. You have to always check if the potential ordinary shares is dilutive in nature before you go ahead to compute for your diluted earnings per share. How do we determine? How do you check if the potential ordinary shares or the warrant or the options that we have in the question are dilutive? How do we check? You first have to go through all this process, and then when you are done, you account for them separately. So here you can look at your earnings per share for only this one as your earnings here, which is 140,000, all divided by your 1,200,000. See, I'm doing it separately to check for dilutive, to check if the preference shares is going to be dilutive. Now, if you compute for this and it is more than this one, then that means it's not dilutive. So 140,000 divided by 1,200,000 shares. This is giving us 12 cents or $0.12 per share. And this is way below our basic earnings per share, indicating that this our new shares is what is dilutive in nature. So it's dilutive in nature. So once it's dilutive in nature, we can go ahead and then compute for our diluted earnings per share. There are sometimes in the question where you have two different convertible instruments. So you may have one 5%, another one will be maybe 10%, 10%, 2 million convertible bond. So you see, there are two different financial instruments or compound instruments, or in other words, convertible instruments in this particular question. When that happens, you have to check for which of them is dilutive and which of them is not dilutive using the same approach. Now, take note, if they are all dilutive, then we'll go for the one that is highly dilutive first. So if we compute for this one, we are getting 0.12, and we compute for this one, we are getting 0.50. Then you can see that this one is more dilutive. We will first include this one in our computation of diluted earnings per share. When we are done, then we come and take this one and then include that one to compute for our diluted earnings per share. Remember that if this one happens to be $4 per share, then it is not dilutive. Comparing it with your basic earnings per share, it is not dilutive. Therefore, you don't need to even calculate or include them in the computation for your diluted earnings per share. In this case, only the first one will be included in the computation of the diluted earnings per share. Kindly take note of these exceptions. Take note of these exceptions to situations where the convertible instrument is dilutive and situations where the convertible instrument is not dilutive. To check that, you do the separate, use the basic earnings per share formula to find their dilutiveness, whether they are like more dilutive or less dilutive in nature. So it's your notional profit divided by your notional shares. That will give you the means or the benchmark to see whether it is what diluted or not what diluted. So this is how to check it. So please take note. If it is also issued during the period, you take the amount into consideration. All right. So here we are having 1.2 million shares. So let's compute for it and see. So we are having 12.14. That is going to be our earnings. 12.14 all divided by our 5.2. That is giving us 2.33. So our diluted earnings per share is going to be 2.33 per share. So you can see that this is lesser than our basic earnings per share. That is why it is a diluted earnings per share. There are some times where you will be given information for two periods so that you can compute for the comparative year diluted earnings per share, and how to determine comparative earnings per share have been covered in our previous lessons, so you can look at that. So all that we've done so far, it is on convertible instrument. Now let's look at how to determine our earnings per share when it is a warrant or is an option. Now, anytime an entity undertakes an option or a warrant contract, like I stated earlier on, it gives the holder the right to acquire a certain number of shares in the future at a predetermined price today. So let's assume that the share options here is 200,000. So entity is going to sell 200,000 shares to a holder at an amount of $2 in 3 years to come. The entity is going to sell this one. This is the predetermined price. Okay. Now let's assume that after that 3 years, the fair value of the shares, so the fair value of the shares, which is also known as the market value, is $3. So you can see some differences over here. Now the amount we are going to sell the shares to the option holder is different from the value in the market value or the fair value. Anytime this thing happens, it's giving rise to our issue of dilution. Now, these two, we are going to receive 2 cedis, which the entity, 2 cedis of the share. So you multiply this by this, you are going to get $400,000. Okay, that's what the entity is going to receive, and that capital that the entity receives can be used for investment, which will affect our earnings. Okay, so these $2 will not give rise to dilution. It will not give rise to dilution because the implication here is that the money you receive will be used for investment, which will also have a proportionate increase in your earnings. So the effect will be the same. You do not have any dilution. What about the $1 that is left? That is, you are issuing the shares to the option holder or the warrant holder at a bonus or free. So that particular aspect of the shares is the one that is going to give rise to dilution. So please take note. So in this question, the share options is 200,000. The exercise price, so we call this one exercise price because this is the price at which the option holder is going to exercise. Is going to buy the shares in the predetermined or in the future. But in the future, this is our price. For you to determine your basic earnings per share, is going to be, let's assume that our earnings is still $20,000 for the period. Okay, then our diluted earnings per share in this question is going to be the share option. So in this question, it's going to be 200,000 times the fair value of the share minus the exercise price. Like I said, exercise price is the one that minus the exercise price, all divided by the fair value. Once you've done this, we are going to get the notional profit. This is going to give us the notional profit. Sorry, this is not your your diluted, and this is going to give us our notional shares. So this is going to give us our notional shares. Okay. So once we get the notional shares, then we can now go and compute for our diluted earnings per share. Assuming we are capitalized with predetermined shares. Okay. Let's say we are capitalized with a predetermined shares of 100,000.
100,000 shares. So the entity is capitalized with 100,000 shares
at the beginning of the period. Okay. So this is how to determine your notional shares when it is option or a warrant. When it's options or a warrant. You see, this is taking a different approach. So in this particular scenario here, our share option is going to be 200,000. Remember, our fair value is $3 minus 2 all divided by 3. So we are multiplying. So this is giving us 1 on 3 times 200,000. This is giving us 66,667, leaving that whole number shares. So this is what this particular one is going to be the one to account for dilution. The 2 will not account for dilution because that one we are going to receive some amount of capital which will be invested in the business, which will give a proportionate increase in our earnings. So that one is not going to, that portion is not going to give rise to what we call dilution, or it's not going to make the additional shares dilutive in nature. Okay, so in this question, our diluted earnings per share will now be the $20,000 all divided by our we were capitalized with 100,000 shares. So 100,000 shares plus 66,667. So this is going to give us 20,000 divided by 166,667. It is giving us 1.2 per share. 1.2 per share. Then the question is, what about if your exercise price is more than the fair value? So let's say this 3.5 is more than the fair value. That means what it's trying to tell you is that the options that the ordinary share that is going to convert it into, okay, in the future is not dilutive in nature. Anytime this is the situation, that means the shares, the potential ordinary share does not carry dilutive in nature, or is not dilutive in nature. The potential ordinary shares is not dilutive in nature. Anytime the exercise price is more than the fair value, then the potential ordinary shares is not dilutive in nature. So this is actually the end of earnings per share. So don't forget to look at all the situations, all the circumstances under which we can compute for our earnings per share and our basic earnings per share. Don't forget, we look at the importance of earnings per share at the beginning of our lesson, and we have to also look at the limitations of earnings per share. When we talk about earnings per share, it also has some limitations. One of the limitations is that earnings per share is based on profit. It's based on profit, and profit does not take into consideration inflation. That is one. Profit can be manipulated by the managers, can be manipulated. There are figures that can be inflated. When we talk about earnings per share, it is not the only basic means to determine or to ascertain the performance of the business, but shareholders always place much importance on the earnings per share, which can also be a limitation. Now, the notion here is that anytime shares are increased in the period, we assume that that share will give us a proportionate increase in our earnings per share. But in practice, that is not true. That is not true. That is not true. So that is also one of the limitations. So these are the few limitations that can come with earnings per share. Aside its importance, it also has those shortfalls. So thank you. So we are going to proceed our lesson on other standards and expect lessons on management accounting, financial management, financial accounting very soon on the channel. Thank you always, and do not forget to share, subscribe, and then like. Thank you.